The conference doors are now closing. Please take your seats. The conference doors are now closing. Please take your seats.
All right, welcome back. I hope all of you are caffeinated. You've got at least 2 or 3 more contacts in your Rolodex and are ready for where the good stuff actually starts, and this is the panel discussions. Just a reminder, you'll see on your name cards, there's a QR code. Please scan that QR code. It will take you to a form where you can ask any question you'd like to our panelists. If we don't get to your questions, we'll be sure to follow it up with an email. So every single question today submitted will get a response, if not addressed directly by the speakers on stage. All right, so our first panel for the day puts 2 of the most debated institutional entry points head to head: tokenized real-world assets and spot crypto ETFs. And taking the charge there is our moderator, Andjelopolj, who is the Vice President for Product Experience at Luno. Alex has spent years thinking about how institutions interact with digital assets at a structural level. Joining him on the panel today is Hemash, the Head of Strategy Execution at the Johannesburg Stock Exchange, Robyn Lawson, the Head of Digital Product Custody at Absa, and Meyer, the Managing Director of Prescient Capital Markets. Let's give a round of applause to our panelists.
Great. Good morning, goeiemorgen, dumela, molweni, sawubona. We are a rainbow nation, so it's great to have you all here. And good luck to Bafana this evening. Today, as Krista introduced, we're going to be talking about kind of the 2 kind of flagship institutional adoption entry points, which has been spot crypto ETFs, as well as against tokenized real-world assets. But let's just take a step back, because we're all here to learn. So let's actually talk, what do those really mean? So at a simple level, a local spot ETF is really locally listed daily liquidity in a regulated wrapper that is recognized by regulation, where you have tracking error that you can model, and it's of a traditional kind of Bitcoin or Ethereum type asset, so crypto asset. Compare that to tokenized real-world assets, or RWAs. You heard James speak about that with some really interesting stats. And ultimately, they give you programmability, 24/7 liquidity, fractional access, as well as distribution into kind of any digital channel, theoretically of any asset class. So starting with those two kind of definitions, we're going to take a kind of a very broad macro strategy view and then pull it down into kind of practical implications and how these institutions that we have here are challenging and looking at them. So firstly, Hemash, before we talk about where institutions are spending their time, investing capital in terms of building these opportunities, like, what is the problem we're actually trying to solve? Is this just technology kind of looking for a problem, or is there something fundamentally there? Maybe you can elaborate.
Thanks, Alex. I think if we look at the problem statement, it's very important to understand the problem before we can actually understand where the capital is going to flow first. I think if we break it up into what problem is crypto ETFs looking to solve, I think the key thing there is about getting institutional access and compliance to crypto markets, right, in a very regulated fashion. Whereas tokenized real-world assets, it's all about increasing distribution, increasing liquidity, as James mentioned, and more importantly, trying to solve some of the inefficiencies of the current market infrastructure that we have today. Now, if we look globally, what's happening, the demand for crypto assets or crypto ETFs has already been proven over the last 2.5 years with BlackRock ETFs and a whole bunch of ETFs coming on board and sort of pension funds and institutionals coming on board. And the reason for that is because they are allowing these crypto ETFs a simple way for institutionals to add them into their portfolios without building brand new infrastructure. They're piggybacking off the existing rails, existing frameworks, existing compliance. So all of that works very well. So it's a very low cost entry point for them to get in. And it also doesn't require them to build all of the underlying custody infrastructure required to hold spot cryptos, which is a very important factor for them. On the tokenized real-world assets, if we talk about distribution and additional liquidity, today the institutional investors already have access to these asset classes. So it's not necessarily something new for them. It's just a matter of creating maybe a more efficient way of getting those assets. So I think those are the two sort of problem statements.
Okay, fantastic. And you touched on something really important, which segues nicely into, for you, Robyn, I mean, congratulations, Absa's built and partnered with Ripple on the institutional custody solution. You're doing some really interesting stuff in the tokenized space, but maybe you can tell us around the decisions on the infrastructure. What are you seeing from clients? Is that infrastructure, that custody being built for real-world assets, or is it actually for, custodying underlying spot crypto?
Yeah, thanks, Alex. Look, I think over the last few years, Absa's really viewed this space as a place that we want to be participating in. Certainly the conversations with the clients over the last few years has started to evolve as we've seen the adoption, as we've seen that regulatory clarity coming through, and I know there's still a way to go, but the conversations initially were really around cryptocurrencies, your Bitcoin, that exposure through the various vehicles. It's now very much focused on tokenization of real-world assets. And what are the benefits? How can they safely participate? And from Absa's point of view, and I suppose particularly from a personal point of view, custody and that wallet infrastructure plays quite a pivotal role in the management of those tokens that have been issued, the safekeeping, the governance, being able to have that conversation with board members, with auditors as well. And so there is, from an infrastructure point of view, a place, I think, where, this convergence between fintechs, between the banks, and of course, in partnership with our regulatory oversight, is the place where we are moving to. And I think crypto ETFs or similar certainly are well adopted, fairly well understood because of the global players. They're here for the sprint. And in reference, I suppose, to comrades taking place, I think tokenization of real-world assets is here for the marathon run.
Okay, excellent. And we just had a global marathon in Cape Town, so that's a great analogy. Maybe let's pivot to Ben. Ben, we've seen a lot of SA wealth managers moving their customers' assets offshore to gain exposure to digital assets as well as to crypto. And that uses their annual allowance. So how is Prescient thinking about your future product development with respect to tokenized real-world assets, crypto ETFs, creating a locally listed crypto product?
Thank you, Alex. Let me just say, from a Prescient perspective, I can tell you our Prescient Capital Markets is thinking of it, not from a Prescient Group perspective, because the Prescient Group got the investment management side. They've got a view of how they think of it. We've got the stockbroking side, and then we've got the Prescient Fund Services, and Prescient Capital Markets operate within the Prescient Fund Services environment. Now, what we do at Prescient Capital Markets, we build plumbing and infrastructure for ETPs sort of on exchange. Now, if you look at the capital market function for exchange-traded funds, it deals with the creation, it deals with the redemptions, it deals with the capital flow, it deals with the cash flow management, and very importantly, also it deals with distribution. So we speak to a lot of clients that want to do ETFs, and then the most important question that we ask them is that, now, what is your distribution strategy? So we don't specifically look at if you look at Bitcoin ETFs, we saw 2 years ago huge demand, and we've engaged with the JSE to look at regulatory changes. The regulatory changes in the listings requirements sits at the FSCA at the moment. I believe there's kickback on that. It's going to be quite some time before we see crypto ETFs in South Africa. So, but what's interesting is that if you look at the demand for crypto ETFs, it was great 2 years ago. Now everybody's quiet. Why? Because the price dropped 45%, right? So, I mean, that's your marathon story, So so we don't take a strong view at Prescient Capital Markets on the product side. What's the next big thing? We reactionary, right? So clients come to us and they want to have solutions, and we help them to build those solutions. Now, so that's what we see in the crypto ETF space. Lots of demand 2 years ago. All the 8 clients that I spoke to, horribly quiet at the moment. Now, the thing is, why was there so much demand? And I think Mesh, you touched on it. The ETF wrapper for a Bitcoin becomes a distribution play, right? Institutional investors can now easier, because of the infrastructure, access a crypto asset via ETF wrapper. So you have a sort of like jump from, the blockchain, to the sort of like more traditional settlement environment, like the CSD straight environment in South Africa. Now, if you compare that to the tokenized world, what that now is a jump sort of the other way, because now you've got an asset that sits in the traditional straight CSD world, and that asset can be a share listed on a stock exchange. That asset can be an ETF itself, right? And now you can have a scenario where you can tokenize that ETF, and then you jump into another infrastructure, and that is very exciting. That is. As I mentioned, from a capital markets perspective, we look at the distribution side of things, and that opens a whole new distribution opportunity. There's a lot of feedback that we get from various stakeholders that you've got participants on the blockchain that don't want to get off the chain, but they want to diversify risk. They say, seeing that Bitcoin is not and Ethereum and other assets is not a one-way street. They see it as they want to diversify assets. Maybe they made money, maybe they lost money, what have you. So now to tokenize other assets, and we've seen the BlackRock where they tokenize the money markets fund, for instance. That's a good example of getting a sort of yield. I know that you can, through lending of Bitcoin, get yield in that, but that's a different game altogether. So if you tokenize in a money market fund and you have it then on chain, that gives the opportunity. But then you can go to one step further. So you can then tokenize any other real world asset to give that diversification. So it doesn't become a what's the next big thing sort of thing. It becomes a distribution. I think James touched on it in his presentation. It's about distribution. It's a different distribution channel. It's interesting. One of my colleagues, he's not here now, he stepped out to get a snack probably, was at a crypto conference quite recently in London, and I've attended a lot of ETF conferences. And a lot of the themes at the ETF conferences that one attends, they would tell you, mutual funds, unit trust, that's old school, that's rubbish, that's dead. It's gone, The ETF wrapper, that's now the wrapper. It's going to take over the whole world, So my colleague went to a conference a couple of weeks back, and they say, no, this ETF wrapper is rubbish, Tokenization, that's the new wrapper, So I think the risk there, the reason I mentioned that example, the risk is there is to just jump onto something for the hell of it, This is like new, is interesting, is exciting. But then you go back to what you mentioned right in the beginning. What's the problem you're trying to solve? Now, the problem you're trying to solve is distribution. I think a lot of these sort of ecosystem can exist in parallel, because you're at Absa. I'm sure it's quite hard to change the direction of the ship. The bigger the institution, financial institutions are big institutions. You don't just jump from one infrastructure to the next infrastructure. But I think and that's what excites me about tokenization. It's a way to jump between sort of ecosystems, right? Of the same real world assets. The risk, though, last thing I want to say about tokenization is what we've seen in Europe. Again, in the ETF space with Kraken, that tokens on ETFs, on US ETFs, that you can now trade in Europe. And from a regulatory perspective, you can't trade US ETFs in Europe. So now there's a risk, and this is for the regulators to solve, is that tokenization creates a scenario where you can jump, the regulatory fence. Because the tokens are regulated as in the crypto sort of regulated, like the MiCA sort of framework in Europe, and the ETFs is regulated from an ESMA sort of framework and a UCITS framework. But now you can jump to sort of regulatory fence. Now you can buy assets by a token that generally you wouldn't be able to buy. So that in itself is a challenge.
Okay. And Hemash, there's quite a lot with what Ben is saying around the regulation, the classification of digital assets. That has big implications for the JSE. How are you thinking about it from a strategic perspective in terms of the role that the JSE plays from a distribution perspective, and then these new distribution channels that are coming up?
I think regulation is critical for us. Regulation is the key enabler. Particularly if you think of the JSE, we are sort of a B2B business. We don't do direct retail type trading, so we're heavily reliant on and governed by strong regulation. And in a regulatory environment, if you look at our secondary market trading, we're highly governed by FSCA. All of our trading operations, our issuing regulations, all governed very stringently by regulation. For us to bring crypto assets into this ecosystem, we would require a lot of regulatory clarity. And more importantly, if we were to take it the other way, if we were to take our traditional assets and tokenize it, there's still a lot of uncertainty around how do we classify a token. Mm-hmm. Is it a security token? So now we've seen a lot of headway being made by the Clarity Act in the US, and hopefully that starts getting sort of adopted globally. But we're still in its infancy. There's still a lot of uncertainty around how to classify a security token, and all the way from. Then we sort of talk about distribution and access. Now, while distribution and access is great, what it starts doing is fragmenting liquidity. So if we were to take, let's say, all of the equity on the JSE, tokenize it and allow it to be distributed on multiple crypto exchanges, where does the liquidity go? And especially at the institutional level, retail level, that's fine. But in institutional level, when you're looking to unwind a massive portfolio or rebalance your portfolio, you need that deep liquidity pools. The South African market is quite small, unlike the US that has multiple MTFs and so on that can handle multiple exchanges. But liquidity is very, very important. So whilst distribution is important, maybe important at a retail level, but at institutional level, we need strong, deep liquidity pools
Fantastic.
to achieve that.
Okay, so I'm hearing distribution, I'm hearing liquidity, and then also the critical underlying infrastructure. And maybe just on the distribution to tie up with the problems being solved, it's about how can you bring that product, that asset to the customer that is demanding it in the format, in the way that they can actually accept based on the current kind of existing financial infrastructure. That's more from an institutional wealth management perspective. Mm-hmm. Then you have these crypto native players that are ultimately, they're sitting in digital assets, but they're wanting to purchase US equities, ETFs, etc., like Ben was alluding to, mm-hmm. and that's the problem we're solving there. Mm-hmm. So really interesting on that liquidity front. Ben, it looked like you wanted to say something.
Yeah, I mean, I hear what you're saying from a liquidity perspective, but there's actually only relevant for tokenizing companies, specific company listings. Is less relevant if you tokenize structured products or ETFs, because from a liquidity perspective, the nature of the product creates liquidity in itself, because you typically have market makers, you have authorized participants that provide that liquidity, so. And that is where the structured product world, the ETF world, there is natural liquidity there. It's different than you go to a big liquidity pool. Most of the liquidity in ETFs, in fact, sits off exchange. And I think that's a threat to the exchange itself. This whole tokenized world, I think you don't have to centralize liquidity because it's product dependent. If you have, as example, if you have a token on a BlackRock, S&P 500 ETF, one of the most liquid traded instruments in the world. A Luno platform can trade that token. Liquidity is not a problem. Then you don't have to centralize the liquidity. So I hear where the JC is coming from. Because you want to. I agree from a company perspective, from a listed company perspective, it makes sense that you don't want to spread liquidity at multiple things. But if one looks at where's the real growth area in tokenized assets, I think it's probably more in the fund side, on the ETF side, potentially on the private equity side and private credit side, which is an ecosystem outside of your traditional stock exchanges.
Okay, excellent. And maybe just a little pivot to Robyn. Robyn, you're one of the first banks that have actually announced a working custody solution, lots of work on the tokenization front as well. So what are the conversations you're having with clients, compliance, risk? What are the sort of new risks that tokenization brings and that you're trying to navigate?
No, I think to be fair, it's been a series of very detailed conversations over the course of multiple years to get to this point. I feel one thing that we did very well, if I don't mind saying, is bringing our core stakeholders on the journey. Someone said to me the other day that either you work with the organisation or the organisation's going to work against you. And to the big ship, you need to make sure that all the players are on board and you're bringing them on the journey and you're going forward in the right direction. And so whether that's with our internal regulatory teams, our financial crime teams, our compliance teams, and the list can go on. So bringing, I suppose, everyone on that journey has really enabled the next phase of the conversation around now what? So we got the wallet infrastructure, now what? What does tokenization is looking for or looking at? The conversations we're having with clients initially, and Benny raised a very good point, is around those off-chain assets more so than something in the South Africa context, whilst we, talking to the JSE, continuing the conversation with our regulators, is around those off-chain assets, whether that is the sort of credit, deposits, private equity, and that's the direction, I think, of where we are going more than anything else. And, but as a bank, with our fiduciary responsibilities, it's not going to be here tomorrow. We still need that continuous legal certainty, regulatory clarity, and of course infrastructure, because there is that sort of traditional finance converging with now all this innovation in fintech. And actually, sorry, that just triggers something for me. One of the often the conversation with from I guess a client point of view is that integration or that integrated view of assets. So those who are moving first in terms of an adoption point of view still will be holding traditional investments, assets, etc. And they want an entirety of a view. They want that interoperability. They want that full ecosystem. So I think, the two are going to marry at some point, but at this point in time, there's still a need, I suppose, to build that umbrella or bridging of the full view for client as well. So that's another sort of frame that when we think about from a banking point of view is those traditional investments, those traditional services, collateral, security lending, those sort of things, and how's that bridge happening then into now this new financial ecosystem, and then at what point are we going to see a full convergence?
True convergence happening. And I mean, as we've seen some of the trends that are happening with the likes of BlackRock bringing the tokenized assets into their Aladdin platform to be able to be distributed by their advisors and get a single view of customer, that's quite telling of the direction that the world is taking, and actually abstracting away whether it's on-chain or off-chain, but silently kind of directing it to the more efficient sort of on-chain tokenized rails. Just tying together also, you mentioned the more illiquid assets that are not necessarily available to retail investors, and even for professional or qualified investors can be difficult to gain access to private equity, private credit, etc. Now, you marry that with liquidity, and I think one of the outcomes we'd also like from LIDAC is planting seeds for new businesses to spring up. It sounds like there's a gap for kind of institutional market makers to play a role in that arena, because just putting something on chain without distribution means nothing, and without liquidity means nothing. So it's about that all coming together. I mean, any thoughts on how we solve that liquidity problem for the more illiquid assets? Maybe to the panel.
With difficulty. Because the more liquid the underlying assets, the harder it is to have a liquidity provider. So that's the first point. I mean, I think if you look at illiquid assets like credit side, one would assume the banks would play there because they see flows. If you see flows on the credit side, one could presume, but maybe that's a question for Robyn to answer from the bank's perspective. But that is a fundamental problem. The more, as you said, I can speak from my expertise is really in the ETF space. Your ETF is only as liquid as the underlying assets of the ETF. So that is important, and is also as liquid as the structure of the ETF creates liquidity, the whole creation redemption structure that one can do. But for a creation redemption structure to work efficiently, you need liquidity in the underlying. Which I think it's a great idea, and I support that idea. But to Robyn's point, there's a lot of work that still needs to be done on non-traditional illiquid assets and tokenize the thing. The fact that something is tokenized and on an exchange doesn't mean it's suddenly liquid. So you still sit with underlying assets that's illiquid, which, if you allow me to speak my book completely, I believe a big market for tokenization is, and what BlackRock, what Kraken has done, is to tokenize ETFs and put that on change. Why you want to do that? Because the underlying nature of the thing is super liquid, more liquid than most individual company listings. So if I look at my selfish view, and if I look at my selfish crystal ball, I would say you're probably going to see more tokenization of what you see currently is the money market funds, and you're going to see tokenization of ETFs. Why? Because money market funds and ETFs is very liquid. You talk about, a big thing has been made about 24-hour trading on tokens. Well, so what? If there's no liquidity in the underlying, doesn't matter if you trade 24 hours. Longer trade, 24 hours trading doesn't give you liquidity. So you have to look at the underlying where you're going to get the liquidity. So I've skillfully avoided the question and passing it on to Robyn because I've got no idea you're going to provide liquidity in private assets.
You're running a marathon, so.
I think, in the large part, I do agree with you, but there's one point that I think ultimately steps out, and I'm going to link it back to James's presentation around concept of wrapper, right? Is that when we are talking tokenized real-world assets, and particularly I suppose in its current form, whether it's money market funds, whether it's credit, is the risk actually doesn't really change, right? In fact, the risk for the underlying asset is still prevalent. What you're introducing is new risks or strategies that you need to consider. And whether that is through distributional channels, whether that's through the tech itself, if we're issuing tokens, underlying smart contracts, new regulatory frameworks. So I think my comment, or just adding to that, is when looking at the play, in looking at solving the problem, you've also got to appreciate that risk profile doesn't change until you start layering in new risks to consider as well. And that's the difference, I suppose, between the native versus the wrappers.
A lot to consider and layers to work through. So one of the other areas that I wanted to discuss was, we're seeing, for example, and this is for Hemash, the Nasdaq's partnered with Kraken's parent, Payward. We've got the New York Stock Exchange partnering with BlackRock and Securitize. And then we've got the DTCC, using the Canton network, distributing the JP Morgan coin. So quite a lot of partnerships happening with big exchanges and kind of digital natives with a kind of a strong institutional supporter. What is the JSE's approach towards this in terms of infrastructure, legal, partnership? What are the hurdles that you're crossing and how you're thinking about it?
Yeah, I think at the JSE, I think we definitely recognize that this evolution to a tokenized economy is happening, whether we like it or not. I think we need to be able to keep up with our peers and make sure that we transition into this new world or this new tokenized economy. I think in doing that, however, it's still fairly early days. If you look at the two models that are emerging right now between the Nasdaqs and the NYSEs, is that some are thinking, let's build a standalone digital asset exchange from the grounds up. And others are saying, let's try and transition or adapt our existing operating model to enable digital assets as part of our ecosystem. Who will win that race right now? Still uncertain, but it still begs the question. I mean, the challenges between the two is that if you're building a separate digital asset exchange to tokenize all of your assets and launch it on this digital exchange, at some point you're going to reach this bifurcation of liquidity problem that we speak about. And where do you start pushing that, right? So if you've got 50% of liquidity in one, then you need some clever, smart order routing. So it becomes quite challenging. On the other side, if you try and sort of transition your existing platforms to enable digital assets, you smoothen that out a little bit more, meaning that from a trading perspective, you can have the same asset, execute with the same liquidity pools, and on the back and on the post-trade side, you can decide how you want to settle.
Yes.
Whether you want to settle in a token format or whether you want to settle via your traditional CST, all of that could be more seamless, and the transition could be a lot more seamless. So having said that, we sort of actively monitoring which is the right path for us, and how do we partner to get that speed when it comes. In addition to all of that, I think one still has to think about the regulatory clarity around what is a tokenized real-world asset, and how do you classify that? If we underlying, is it a commodity, is it an ETF, is it a stock, is it a bond, is it any other illiquid asset, property or whatever? We need that clarity in order for institutionals to start adopting that and holding that on their books and reporting on it. So
okay, excellent. Well, if you're looking to build a digital asset exchange, you know who to speak to, and we'll happily come in and help you out, and as together with that liquidity as well. So we've got some ideas on smart order routing and how we can kind of augment liquidity. What I did want to maybe also ask is there any connection with how you're thinking about digital assets, your infrastructure kind of rebuild and future, and Operation Phumelela, SA's vision of becoming a synthetic financial center?
Mm-hmm. Yeah, I think it's vital for us as an exchange to make sure that we can service the domestic demand. And I think for all of us in the room today, I think it's important to actively build local solutions and local infrastructure to serve the local demand. If we don't do that and we see the demand grow, all that's going to happen is all of that demand is going to get serviced by offshore clients. So I think from our perspective, we're looking at it at a macro lens and SA Inc. lens. I think it's very important for us to keep up with the global trends and global demands and transition our infrastructure to cater for all of that. So very important. And that we are heavily reliant on regulators to help us on that journey to get there.
Absolutely. Yeah. And look, Luno built its moat over the last 13 years by being pro-regulation, pro-constructive policy formation. So, we're all in it together. I think that the people in this room are testament to the interest in the space. Regulation is critical. I'm going to ask a question now to Ben. Ben, so crypto is not permitted as an asset class under CISCA. Reg 28 keeps it kind of out of pension funds, although there's a little bit of the other category that you could put it into. Like, what changes do we need to see from National Treasury and the asset management industry to get kind of any allocation, even small, into unit trusts, pension funds, etc.?
Yeah, as you mentioned, as I understand it, and I'm not an expert on Reg 28, but I'm aware of some life companies that hold a very small portion to diversify risk. I think it's within 5%, or I think that's the limit that you can.
Life companies, you said?
Sorry?
You said life companies?
Yeah.
In the life wrapper, okay.
Yeah, so you can already do it, right? But it's under the other category. If you say what needs to change, it's really, everybody always say, education, that's what we need. But it's actually quite true, right? I mean, it's the frustration often when you deal with regulators, but I suppose it's like with all of that. We're always fearful of the unknown. The moment you start speaking to the FSCA about crypto assets, what the hell is this? Okay, now I don't know what it is. Oh, it's Bitcoin. Oh, that's that rubbish thing that goes up to like 120 and drops to 65,000, That's that sort of the thing. Oh, it's like very volatile kind of thing, It's interesting, I saw a study a year ago. Last year, I think that the S&P 500 index was more volatile than Bitcoin. But that's allowed in the assets, and Bitcoin's not allowed in the assets. So that's a little bit bizarre in a way. If you just look at it from a volatility perspective, is that your reason? If you say Bitcoin is rubbish, is not a real asset, that's a completely different discussion. So I think that the discussions like this, conferences like this, general education, what Luno is doing, this interaction with the policymakers helps a hell of a lot in getting the understanding and having that sort of mutual understanding. How does the regulators look at it, and how do the market look at it? So once we get to that level where the assets are better understood and the risk are better understood, then one can sort of make progress. I'm involved currently in a project at the JSE. Do you want some water?
Yeah,
I think it's a good idea.
If you don't mind.
Sorry. So while Robyn's getting water, I'm involved in a project at the JSE to have regulation around crypto ETFs. And there was a lot of interaction with Luno is also involved in that interaction with the stock exchange, and there's a very good set of rules that's from a listings requirement perspective that's been presented to the FSCA, and not an official view. It's just sort of ears close to the ground. People have told me, listen, that thing is completely being stalled. That thing went to the FSCA. I keep on pushing the JSE. When is comments going to go out to the market? The issue people actually don't know. But you know, it's sort of like that rabbit in the headlights saying, whoa, what we faced with now, you know, rather say nothing, you know, let's just like sit back, you know. So for me, it's that constant interaction and with the regulator and what one needs. And this is now coming from when I was at the Johannesburg Stock Exchange 10 years ago. No, not 10 years ago. I was there for 10 years. Bloody hell, it was 20 years ago. Sorry. I worked in a regulatory environment in an issuer reg at the JSE, and there's always been a us and them thing with a regulator. You know, the regulator doesn't trust the market. The regulator believes the market wants to pull the wool over its eyes, and with respect, often it does happen, right? Not Luno, but often it does happen because market participants want to be the first, and they want to push things through to the regulator, you know, and then they just come with all these stories, you know, why certain things should be allowed and shouldn't be allowed, you know. So and if there's no trust environment, it's very, very difficult to make progress, you know. So I'm not 100% sure where the trust environment is at the moment. If you look at from a crypto asset perspective and the regulators, you know, I mean, I would suspect a couple of years back, there wasn't a lot of trust because you had all these scandals, you know. I mean, whenever there's you know, it's not everyone in a crypto world is a crook, but every crook is involved in the crypto world. You know, you have that environment, you know, and that doesn't bode well for progress. So the first most important thing is there must be a trust that everybody works towards a common goal. You know, and I think, and I come back to James's presentation, which was super enlightening, you know, because from a Luno perspective, you're moving away from the retail Bitcoin, come and make your fortunes on this platform thing, to what is a secure infrastructure in a regulator to remind that serves the financial community best, you know, or makes a contribution to the financial ecosystem. So if that trust is there, then you can build on that and go forward. Back to your marathon, right? You're not going to solve this regulatory problems. Challenges is the political right thing to say, I presume, you know, but let's call it problems. You're going to solve it in the short term. You know, build up the trust, build up the understanding, and then engage and have sensible discussions.
Absolutely. And I mean, one of the ways Luno has tried to position itself to continue to build trust with retail is not to emphasize that FOMO, green candle kind of mentality. It's actually about access, education, understanding, safety, security. And I think that it's now about building that trust environment with institutions, with the regulator, as you know, as the industry continues to grow. And I think, you know, there were comments around nobody speaking about Bitcoin ETFs now when the price is at 65,000. Yep. That's actually the best point in which to get your customers to buy the assets, as opposed to when there is a frothy market and lots of green candles and stats coming out of the US and the ETFs.
Yeah, but you're making the assumption that Bitcoin is an asset then. So.
Shots fired. One of the things that we've talked about Bitcoin, we've talked about tokenized real-world assets. One of the tokenized real-world assets that hasn't come up on the panel yet, which is dominant, is stablecoins. And what is the role that stablecoins play in your mind? And maybe let me bring this to Robyn. You okay?
Oh, I'm not going to lie, I'm struggling a little bit here. Something's triggered me.
Sorry.
We can...
Should we segue to Hemash then?
Sure, I think on our side, you know, stable coins, or at least payments, plays a vital role in how we settle the DVP settlement between our cash markets, whether you're trading a security for, or selling or buying a security. I think right now, payments, you know, we use the existing SWIFT banking rails for payments. What stable coins will allow us to do is more get that sort of, if we're looking at geographical expansion, if we do a Pan-Africa type of model where we can settle cross-currency a lot easier, the stablecoin rails provides a lot more efficient way of settling that. So if we talk about, you know, access and better distribution, if we want to start selling SA equity to the rest of the world, settling in a USD stablecoin makes it a lot more easy and efficient, and creating liquidity in one pair, rather than trying to have multiple currencies and multiple pairs. You know, so I think from that perspective, stablecoins will enable the JSE to expand geographically and get better distribution.
Sounds like there's something there, a thread there to definitely pull through. Ben, anything from you?
No.
Okay.
I'm not
Robyn,
an expert on
you-
stablecoins. I can't
Okay.
add to.
Hopefully I'll get through. But look, I think we've spoken about use cases for stablecoin, and certainly from a banking point of view, it is of high interest, and not just I'm not just talking about Absa, but across I think the entire banking sector.
Yes.
There's no arguing against the efficiency and the benefits. From Absa's point of view, it is something that we have been actively looking at for some time. And we do see the value, particularly from a Pan-African point of view. We've got offices in 10 jurisdictions. A number of our clients are Pan-Africa. And the benefits, that they can see or reap from having localized stable coins, whether that is currency-backed, fiat-backed, whether that is backed by other assets, gold, for example. And I think there's no denying that there is a room for stable coins. It's something that I think we should be continually to have that discussion, looking forward to the stablecoin framework that is due to come out. So it's certainly not a sideline. It is something that the banking sector are actively looking at, working in, and also, I think, speaking to our partners about as well.
Fantastic. Okay, excellent. Do we have any questions from the audience that we can show on the board? Great, we've got 4 questions. So, in your view, can a CIS be natively issued on-chain with our existing regulations without the token being classified as a digital asset? Who would like to take that one? This speaks, Ben, to the...
Yeah, I'm frowning. I'm not 100% sure I understand the question, to be honest with you. I mean, how are you going to... You can issue a token on a CIS on the chain, but then it's just a token on the CIS. The CIS is still regulated in terms of, fiscal regulation and underlying asset board notice 90, etc. So... but, you can't... in the current environment, as I understand it, if you look at the CIS space, right? If I look at blockchain, blockchain is a decentralized ledger where a record of ownership, call it like that, And if you look at the traditional CIS world, your client liability management sits with the management company. You've got a whole transfer agent function, a whole T8 function at the management company. But then you've got an alternative to that, which is the ETFs, where your client liability management sits in the CSD, sits in straight. Okay,
yes.
And currently that's the only 2 CISs. If you look at that sort of structures, that's sort of allowed in terms of the current legislation. So if that is the case, and if I understand the question correctly, the answer must be no.
Yeah.
Okay, because you can't keep your record of your holders of the CIS itself. Currently within the blockchain. So I hope I answered the question. I'm not sure who asked it, but I'm happy to have a follow-up on that.
Great. Any other comments from anyone else on that one? I think that was well answered. Could we move to the next question, please? Okay. Which factors will be the true tipping point that determines whether capital flows first into spot crypto ETFs or into tokenized real-world assets? I think that there's been a lot of comments around the demand being currently from a tokenized real-world asset perspective. But anything that the panel wants to add to that?
Look, I can maybe add on the crypto ETFs side of things. Came to the market with a big fanfare, a lot of flows in there. The recent article on Bloomberg stating that now the crypto ETFs are partly or predominantly blamed for the current Bitcoin price decline. Because this investments from the crypto ETFs. So again, and apologies, and maybe I'm showing my ignorance here, but I don't really fully understand value of Bitcoin and why it should be assets. It's another argument. It's gold and so forth. That's all good, But if the simple answer is that there's no tipping point for flows into spot crypto ETFs. I mean, it's already happened. There was a huge demand for crypto ETFs. Bitcoin was rallying, going crazy, and I think when BlackRock launched their Bitcoin ETF, it was the most flows ever that they had into an ETF. So the tipping point is the price movement of Bitcoin, right? If you have another rally, you'll have more flows coming into it. That seems to be how the crypto ETFs behave. If I talk about ETF on Bitcoin, ETF on in the tokenized real world assets. I mean, that's for me the exciting growth area, and it's difficult to point to a specific tipping point per se, but what I can point to is that a trend that you see generally in worldwide at the moment. Well, it's a new trend. I mean, the comment was made by everybody. I think Deputy Minister made a comment. Everybody's on their phones now and look at their phones now. And how do you access investments? How does the younger generation? Not me. I only know my phone number, my wife's phone number. That's my cell phone interaction kind of thing. But the general investors, most of investors now invest via apps and that sort of thing, right? And the crypto world is new, it's exciting, and it lends itself to digital access. It lends itself to. This morning I opened my banking app and you guys popped up. My Discovery banking app and said, open your Luno account now. So what the hell, So it's quite fascinating. But the youth respond to that. And one example that I want to use is my son. He just does sport. He's not academic. He's totally into sport and that, but he does sports betting. And through sport betting on the app, and then he came to me the other day and says, Dad, he actually makes money. Everybody at bets claims they make money. So he's claiming me back and bit. I've made a bit of money. What I do now is there's some investments I can buy. And that was the discussion. I say, well, he's used to the app and that sort of thing. So, you can go to this platform, and that sort of thing. So that speaks to tokenized real world assets, speaks to the distribution. So I don't think it's a tipping point. Okay, I think, it already happened. A massive generational change is happening. There's a big drive in Europe to get retail assets out of savings accounts for banks, but into investments, right? So, and that's a huge drive, and a lot of what's already happened is the appearance of so-called neo-brokers. Neo-brokers is brokers that just got an app. You can point the asset to exchange because it's publicly traded. You can point the assets to a crypto exchange, which is also like exchange, or a token on that crypto exchange. So that's already happened. You stand in the tubes in London, you see all these ads, buy your crypto, buy your ETFs, go to eToro or whatever sort of app you have. So that's already happened. So has massive retail assets flown into investments yet? No. But at some point, the term that's being used quite often is democratization of investments, where investors bypass, financial advisors and they become savvy and that sort of thing. And it sort of makes sense because there's more information out there, there's more AI tools out there that one can use. So I don't think it's a tipping point at all. It's already happening in front of us already.
Yeah. No, that's a great comment.
From our perspective, I think it's probably two things. Talking about local in SA, not so much tipping point, but more catalysts. I think regulatory clarity is a big one for us. Once we get that, we've seen that with the Genius Act, and the adoption of stablecoins straight after that was massive. So I think, getting a lot more regulatory certainty will allow institutional players to play more. In addition to that, is building the right infrastructure and enablement to allow them to trade these assets. So crypto assets, if we can get them to trade it on the existing platforms, it becomes a lot more easier, removes the hurdle for them, and so on. So, those two, building the right infrastructure and getting the right regulatory clarity for me is key catalyst for better institutional adoption.
Great. And also, Ben, as you mentioned before, there can be institutional adoption, not necessarily through crypto ETFs, which there's quite an emphasis on, but through life wrappers, for example, because that enables that's enabled based on life co-balance sheets and that regulatory framework.
Correct, but be careful about institutional adoption because institutions are much more regulated. So
Yes.
it come back to the regulatory certainty point that was made over and over.
Yes.
Yeah.
Okay, great. Well, Ben, I hope you told your son to put the money into a tax-free savings account.
Now I'm going to show him the Luno app.
through your banking app.
He'll also discover banking clients, so I can access the Luno app.
But also, I think you mentioned about the non-invested and now investing. So one of the sayings that I've quite enjoyed is, you've heard about banking the unbanked. It's now about brokering the unbrokered without the intermediaries, and that's what digital asset distribution allows, and embedded wallets, and that's how we enabled it through the Discovery app, and we can enable through any digital journey that is out there. I think we've already answered this question, so we won't go there. Is there one more? All right, it doesn't look like it. Great. Well, thank you to my panel, Hemash, Robyn, Ben. Any closing comments for you before we head out?
Yeah, I think from our perspective, we're very passionate about building the right infrastructure, local infrastructure to service local demand. And I think all of us here today, including our regulator, it's very important that we work together to achieve that and avoid all capital flowing offshore.
Absolutely. Thank you.
I'm just going to take a play off of what Ben was saying, particularly around his son, and take it to a more human element. And that is that, we talk about digital adoption, but coming along on this journey, I suppose, given AI, the next generation is instant gratification.
Yes.
And people are not willing to wait now 2 days to see their money at work or their investments at work, or trying to work out who to go to. And it's an interesting one, socially, that construct, instant gratification, but I think partnering with our regulators, with the players in the market, with the banking, that eventually, we will be at that point where efficiency will trump all.
Great. Thank you, Robyn.
I can't add much to that. Well said.
Yeah.
I just think we're at a very, very exciting time from a financial markets perspective, the whole infrastructure perspective. I mean, there's a lot of changes happening on various areas in the ecosystem, and it's starting to be an environment that it's very difficult to see exactly where we're going to be 5 years from now. And that's sort of what excites me the most, is to stay engaged. We at Prescient and also at Prescient Capital Markets, to stay engaged with these latest developments, from a distribution perspective, from an app perspective, because it's really, really changing rapidly.
Absolutely. And I mean, just from an experience perspective that you mentioned, Robyn, having come from cash equities and then the list platform and being in a 24/7 environment for the last 5-6 years, I mean, I'm just blown away when you kind of look at the SLAs around like money market settlements on current list platforms. So it's my mission to change that, as it is Luno's. So thank you for your time, everyone. I hope you enjoyed that.
Thank you.
Right. Thank you, Alex and the panel. I mean, that's exactly the kind of conversation we came here for, right? And I think to to have the luxury to be able to be immersed in the topics like this for a full hour, absolutely incredible. I want to quote Hemash, and I think it was quite a strong quote. I think the evolution to a tokenized economy is happening, and I think that is definitely a leaving thought for this panel. Now, moving on from market structure to the broader macro environment, please welcome our next panel to the stage to debate how the constraints of the legacy financial system prove that economic uncertainty isn't a headwind for digital assets. It's the ultimate argument for them. This panel will be moderated by Marius Reitz, the General Manager for Luno for Africa and Europe. Marius has been at the intersection of African capital markets and digital assets for well over a decade. Joining him on the panel today is Refilwe Molotto, an independent economic strategist, Piet Viljoen, the CEO of RCM, and Adrian Saville, the Director for the Center of African Management and Markets at Gibbs. Let's give a round of applause to the panel.
Want me here? Cool.
Yes.
Yeah.
Right. Thank you very much. I am delighted to be joined by three respected voices in their respective fields. Over the next hour, we will have fun, first and foremost. And secondly, we will navigate four interconnected themes. Firstly, starting on the stresses in the current fiat system. I recently attended a conference where the SARB governor spoke at, and he said that uncertainty is less, only because more uncertainty is a certainty. So I thought that was quite relevant to the current status of the global system. Secondly, we will take a tour around what institutions currently do to hedge themselves against this uncertainty. The role of Bitcoin initially, but how that has evolved behind Bitcoin. We will also talk about the draft capital flow proposals, and we will explore the tension between a borderless network and a exchange control system that was designed for a world where banks control the flow of funds. And then lastly, we will look at Africa as a live experiment where adoption is playing out right in front of our eyes. So I think starting off with the current financial system, for many institutions in this room and operating across emerging markets, stresses like debt, high global debt levels, emerging market currency volatility, high inflation in certain markets, those are not an abstract thesis. It's the reality for many institutions on a daily basis. Adrian, your research sits at the intersection of growth economics and also the health of the global financial system. With all these stresses, high dollar debt, emerging market currencies in a permanent defensive position, if you had to give an investment committee right now a diagnosis of the health of the current financial system, what would that be?
Thanks, Marius. I think one of the dangers of the environment that we find ourselves in is that there's good reason not to panic. When crisis arrives, then there is panic and immediate sort of responses, a sense of urgency. But there's a lot of boiled frog happening. It's an overused quote, but I think it lands well here. And that's Mike Campbell from Ernest Hemingway's The Sun Always Rises, where he says, how do you go bankrupt? And it's slowly, then all of a sudden. And that would be my sort of grandstand position on the world's largest and most influential, important market, the US dollar market. where you've got very elevated debt, you've got sluggish growth, you've got misguided spending. The interest bill in the US now comes in at about $1 trillion a year. And whether you stand on this side of the fence or that side of the fence in the war, not war story, that $1 trillion is bigger than military spend. And so, there's this, I suppose we could put a very big question over the allocation of resources and the capability of what historically has been, for the last 100 years, the single most important denomination, and to ponder whether that continues. If there's no cause for sort of panic in the moment, then we can kick this down the road, and that would be my conversation with an investment committee, is you're kicking this can down the road, because eventually we will run out of road, or the dollar will run out of road. And where do we get guidance from that? We'll just look back over the broad sweep of monetary history, and we can ask what happened to the pound, what happened to a Dutch guilder, what happened to French currency. They were dominant for 100 years, and then they weren't. So I think that's the terrain that we found ourselves in. It's not quite, and unfortunately the US doesn't have the convenience of the Japanese circumstance, where Japanese debt, public debt, government debt sits in public pockets, but those public pockets are Japanese. So the left pocket is lent to the right pocket. And it's unlikely that Japanese households and pensions call out the Japanese government. By comparison, US debt is overwhelmingly held globally. And if that check is cashed, you have a currency crisis and a capital markets crisis that is of unprecedented proportion.
Yeah. Pete, so one can argue then that I think the macro environment is not a headwind for digital asset adoption, but it's an enabler in some sort. And we saw the metrics that James presented this morning showing almost $300 billion worth of value that's being transferred on-chain. History is full of moments when the monetary system lost credibility. You think of the Weimar Republic, you think of the Nixon shock, 1971. And in those cases, capital didn't wait for a solution. Capital moved. So what has history shown us about how free markets respond when the monetary system loses credibility?
Yeah, I mean, that's the key question, isn't it? How do markets respond? I would take it a step back and first of all start with my basic fundamental investment thesis, which rests on two platforms. The first platform is nobody knows anything about the future. And the second platform is markets are always uncertain. So the question is, how do you deal with this, given that those are the platforms on which you stand? Well, I stand on those. And my answer to that is very simply, you diversify. You diversify across geography, and you diversify across asset classes, and I include Bitcoin or crypto as one of the asset classes with which to diversify. And the reason I say that is because I regard Bitcoin at least as what I classify a hard asset. And the definition of a hard asset is something in which is scarce, something which is not somebody else's liability, like the US dollar or debt or equities, and something which is tradable or portable. Those are the characteristics of a hard asset, which should make up part of a well-diversified portfolio. And what's happening globally right now, and it's happening now, and it has happened through the ages, as you point out, is that the supply of money is effectively unlimited, and that's why scarce assets tend to, over time, hold their value, because there aren't more of them, but there's always a lot more money. Governments always print a lot more money, and the history of fiat currencies is they eventually go to zero. All of them eventually go to zero. And that's why something like gold and gemstone diamonds possibly and other precious metals hold their value, scarce assets, and I think Bitcoin is a new incarnation of those types of assets and play a role in reducing your exposure to the killing pens of inflation, as I call it, because that's where governments want you to be. In a free market, You can take your money away from a government and move it somewhere else. But when governments start getting into trouble, they start putting up barriers to capital flows, barriers to people flows. And your job as an investor is to escape those barriers because they're trying to herd you into the killing pen of inflation, because that pays off their debt. They pay off their debt by inflating the money supply. But you need to respond before it gets there. You need to be prepared for it. You can't prepare for it after the fact, because then the gate's up and you can't move anymore. And I think that's probably going to happen over the next 10, 20, 30 years. More exchange controls, more prescribed assets, more barriers and gates on the free flow of capital. And I think, again, that's where cryptos generally and Bitcoin specifically can play an important role in your portfolio.
Okay. Refilwe, I want to come to you. You advise and you sit on investment committees that advise multinationals, especially companies that operate across Africa. How are these institutions navigating and dealing with all these external forces that they play against?
Yeah, I mean, I think what you'll find on the rest of the continent more so than you'll find in South Africa is a greater level of adoption of crypto. And that has a lot to do with the existing financial systems that they have. South Africa's is quite well developed, it's quite deep. Well, we've got a very deep savings pool. Whereas in many of the African countries, whether it be Nigeria, Kenya, Uganda is another place where there's a great deal of adoption. Your largest asset owners are often either the central bank or a national pension scheme. And so there's not as much movement in the system, and so there's not as much of an opportunity, I suppose, for a great deal of upside. The other idiosyncrasy that I find in some of these countries is that many retirement fund members prefer actually to see their assets. They want to be able to say, I own a piece of that building and I want to, I got a sense of it. So it's very interesting to me, the adoption that's been quite rapid. Nigeria, I think, is about 40% of it. South Africa, Kenya, and Uganda follow in terms of the adoption. And I think it really does speak to the lack of depth and the lack of opportunity, the sense of liquidity, and being able to at least see it on your phone, as I think was being discussed a little bit earlier and in the previous panel, is another sense of surety. I'm not waiting for a statement to come out. I can kind of see exactly where I stand on a regular basis. So you see a great deal of trade and business that's been picked up in that regard. And I think a lot of personal participation, people just sort of putting their money offshore as they normally would, except this is much more accessible.
Yeah,
right?
yeah. I think if you put the adoption on the greed to need spectrum, you would see in emerging markets, most of the adoption is driven through need and the use cases behind it. So the system is under stress. The next question is, what do you actually do about it? And Pete spoke about hard assets, Bitcoin, gold, and the flight to those. I think now the conversation is moving beyond Bitcoin. It is how institutions ensure that they run their treasuries on-chain 24/7, 365, that trade settles in minutes, especially in emerging markets where capital controls are still prevalent. So we'll move from Bitcoin as a store of value, and then we'll navigate from there. Pete, I want to come to you. I recently attended a conference where a chief economist put a question to me: how do you value Bitcoin? And Ben mentioned that in the previous panel as well. So can you, I know you wrote a series of articles covering Bitcoin specifically. Can you give us your perspective on your framework that you use to put a value to Bitcoin?
Look, the short answer is you value it with difficulty, but that's the answer to any asset class valuation. Anything you try and value, the value is in the eye of the beholder, and especially so in an asset like Bitcoin, which has no inherent cash flows. But the way I look at it is that you have to look at the valuation of it relative to what it's denominated in. At the moment, Bitcoin is denominated in dollars. And there are more and more dollars being printed all the time, and there aren't more and more Bitcoin being printed. So over time, in dollar terms and fiat currency terms, its price will go up. I have no doubt of it. In the fullness of time, not tomorrow, in the fullness of time. And its value lies in its scarcity. But that doesn't put a number on the value. It just tells you that it will maintain its value over time and become more valuable. I mean, I got some numbers out. I can't remember the numbers, so I made a note of it. Scarce assets, how the valuations vary. So if you look at the Earth's crust, one of the most scarce minerals, commodities in the Earth's crust is rhodium, 1 part per billion. That's how widely spread rhodium is. Its price per ton is $258 million. Gold is 4 parts per billion. That's its occurrence in the Earth's crust. Its price is $137 million per ton. Platinum is 5 parts per billion, also pretty scarce. Its price is $57 million a ton. So you can see the pattern here. The less scarce a commodity becomes, the lower the price is. And then you get to something like copper, which is 60,000 parts per billion. That's $14,000 a ton. Coal is 200,000 parts per billion. Its price is $150 a ton. Down to iron ore, which is 56 million parts per billion in the Earth's crust. Very common, very widespread. Its price is just over $100 a ton. So there's a direct correlation between the price of an asset and its scarcity, and Bitcoin is intrinsically scarce. Therefore, I think over time, its price will go up in fiat currency terms. What the value is today, I mean, that, as I said, the value, I might have one price and Adrian might have another price, you might have another price. In the short term, supply and demand determines the price. At the moment, I think there's a lot more supply coming from previous speculators, so there's a lot of supply coming to the market, so the price is coming down, but that isn't intrinsic value. That's just supply and demand finding a level. Over time, the scarcity will determine the value.
Yeah. Okay.
Can I just add to that very quickly, Maurice? Nassim Taleb's got a superb paper. Off the top of my head, I can't tell you how many pages, 4 or 5 pages, not much longer than that, which speculates on the terminal value of a digital asset and puts the number at 0 because there's a cost of storage, there's a cost of maintenance, preservation, etc. And this is hardly a forum in which I want to square up to Nassim Taleb, but he has a point. But to come in behind Pete, I would add I would put a rider on your observation, Pete, that asset needs to have, there needs to be some desire for that asset. Otherwise, I can tell you I've got a magnificent, Adrian Saville unique. There's only one of them. Yeah. What are you going to pay? Yeah. So there has to be an intrinsic desire for it also.
Yeah. So Adrian, you wear many hats. You're also a portfolio manager, and you run a fund with some exposure to digital assets.
Yes.
Can you give us the rationale for that inclusion?
So I love Pete's opening observation around the 2 things that we can be pretty confident on. The first is that the future is inherently it's not uncertain, it's unknowable. And there's an important distinction between uncertain and unknowable. Uncertain, you can put probabilities down, you can sort of work out risks. And unknowable is a future arrives that you had never anticipated. I think that's the world that we live in. So that's the one circumstance. And the second is, or that's the one principle that I've got going on in my investment approach. The second is that there really is only one free lunch in investing, and it comes through diversification. When we talk about diversification, then I don't think it's about what you own, but rather the size of your positioning. And you're unlikely to blow up a portfolio if you have very, very modest, appropriately sized exposure to assets that behave differently. Where you might go hopelessly wrong is if you say, well, I'm putting 90% of the portfolio in gold, and the year is 2003, or I'm putting 90% of the portfolio in Bitcoin, and the year is 2026. Then you're going to be in big trouble. So I think it's a sizing issue. If we agree on subscribing to the diversification principle, then it's about sizing. And in that portfolio, which I call the nuclear winter portfolio. The end of the earth might come, perhaps it doesn't, but I'd rather be in a position of being ready for it if it does arrive than sort of patting my pockets and wondering where the baked beans and the shotgun is.
Yeah.
So, in there's some other esoteric things. And I think Peter and I perhaps have drunk the same Kool-Aid on this. So I've got, physical land rather than real estate. And I've got some quantum assets, because I think that the day of quantum computing is a lot closer than is broadly suspected.
Yeah, so it's a bet on the future, small allocation, large potential upside, limited downside.
Exactly,
okay.
Exactly. And the downside could be to zero, but it won't be cat food if we go to zero.
Yeah. Refilware, so you advise many boards. You've been involved with the Eskom as well, I think,
Yes.
on Eskom's pension fund.
Yeah.
In many boardrooms, the conversation still evolves around Bitcoin and other crypto assets as speculative trading. But the industry has evolved. The conversation has now evolved to, for example, an Eskom looking at using stablecoin rails to optimize its dealings with other energy companies or with its suppliers, for example.
Right.
So the value that can be unlocked stretches far beyond a mere speculative move. Are those discussions happening? And if not, why not?
I must start with the fact that, unlike portfolio managers whose main role is to seek out opportunities, largely investment committees are a guardrail, a risk mitigant. And so the nature of investment committee conversations does sometimes veer into, well, what is that? It took, for example, at Eskom Pension Fund, it took years when I was still on the asset management side for me to get them into Africa. And you kind of have to remind them that they're sitting on it. and it's happening and it's growing, and you either have to believe that everyone's going to shrivel into a hut and die, or there must be some opportunity there. So they are by nature rather risk averse, particularly if you're talking about like a DC, a defined contribution fund, or even more importantly, a defined benefit fund who track their performance against sort of very low margin above CPI. The payoff for an asset that they're unfamiliar with and having to have oversight for that is sometimes just a little bit, it's too much of a risk, the risk versus the payoff is just not enough. That said, I do think it's incumbent upon the asset management and the assets industry to really march their way into those rooms, because most people hear about these things over dinner conversations or when they see a blow-up that happens to lead a headline and aren't given the appropriate sense of what the real, the sort of the risk mitigation that Adrian was speaking about really is about. And so the conversations are tepid. I mean, nobody's rushing in. These are hundreds of billions of rand that we're talking, hundreds of millions of rand that we're talking about. So putting on a position, it takes quite a few levels of convincing. There's always that one investment committee member who's kind of still in the dark ages and tends to be a very strong voice in these rooms. And the main thing is just to, I guess, to educate. Get the mist out of the picture. For them to attend conferences like this one and get a really good sense about where the world is. Because what tends to happen is it's that same investment committee that will complain to the portfolio managers when they underperform a benchmark or when they underperform their peers. Yeah. And it really is because you guarded us against that.
Yeah. So I think currently it's also not legal. It's not possible for pension funds to hold exposure to crypto assets as well. So
at this particular point, but I do think that the digital framework outlined by the Reserve Bank's digital payment study in 2024 really started to paint the picture about where the world is going. Pension funds are obviously very reticent to move ahead of regulation, but again, much to Adrian's point, don't wait until the day the regulation passes. Be educated on it well before, and I don't think it's a bad idea.
Yeah. Okay, that brings us to the live policy discussion. In April, National Treasury published its draft capital flow regulations, and the reaction has been sharp, to say the least. Exchange controls were designed for a world where moving value required banks, borders, and also intermediaries. That world is changing now. James spoke earlier about institutional participation. In South Africa right now, institutions drive around 75% of all the transaction volumes on local exchanges. So, Pete, I want to come to you first. And maybe there's an obvious answer to this question, but let's explore this. Can you enforce capital controls on a borderless network? Or are we watching a legacy framework trying to contain something that it was never designed to contain in the first place?
Look, I think both those statements are true. It wasn't designed for the world as it's developing right now. And crypto, in its nature, is borderless and doesn't respect boundaries or anything like that. However, it's also true to say that you can't have your cake and eat it. You can't want institutions to invest in crypto and want it to be unregulated, because those two things just don't mix. So if you want it to be adopted by the institutional community, then you should accept the fact that it will be regulated. And I think that's a reality that one needs to face. Institutions will not invest in unregulated assets. It's just, they won't do it. They're looking after pensions and they've got their own rules and regulations they have to follow. It's not going to happen. So I think if you want Bitcoin to be widely followed and invested in by the institutional community and others, you'll have to accept that it will be regulated, and the regulators can control the on and off ramps. I mean, they control the banks. That's the on and off ramps into and out of the system. It's going to happen. That doesn't change the value argument. Just because it becomes regulated doesn't mean the value of the asset changes. So those are two very different arguments.
Yeah, that's a good point. I do think that you need to distinguish between different types of digital assets. Bitcoin as an investment, absolutely. In South Africa, individuals can invest up to, I think it's now 2 million rand in offshore assets, or up to 10 million. And one also has to acknowledge the Reserve Bank's intent. So it's before my time, but during apartheid, I believe it was not possible to externalize even a cent. Then it was increased to 200,000 rand, and then 1 mil, 2 mil, or 10 mil. So the direction of travel is positive, I think, from that perspective. But the industry stretches beyond Bitcoin as a hard speculative asset. So USD stablecoin is increasingly being used to settle cross-border trade. And so I think that is where the tension exists right now between industry, between business, and between the regulators.
I think it's also a fact of life that the regulators always run behind the industry. Whether it's USDT, whether it's any other financial innovation, regulators always behind the curve, and eventually they catch up. And I think that process is happening now. Sorry, I don't want to monopolize things here. But
Can I just tip something in there, Morris, is if we sort of step up from the observation about the specific asset class, and we're trying to regulate this class or ring fence a particular, I take the previous reservation by calling it an asset, this thing. Lots of goes are trying to regulate historically to sort of trap the flow of water. And you take us back to the 70s or the 80s in South Africa, where there was a thing called financial rand. You actually had 2 rands. And the wide speculation was that when you lifted the cap on the financial rand, all hell would break loose. Money would rush for the exit, and you would have a currency crisis and free fall. The exact opposite happened, because releasing the control speaks volumes about your confidence in the asset that you're trying to, or the currency that you're trying to ring fence or corral. And it's, that might be an anecdote if it was just the financial rand, but we could go to, many other episodes. India, when they released controls. Britain, when they released controls. South Korea, when they released controls. Chile, when they released controls. In example after example, we find that allowing capital to enter and leave, on the basis of relative attraction of a destination, just removing the controls improves your relative attractiveness. I mean, ask any parent who's told their children, don't touch that.
Okay, so the history tells an interesting story in that regard.
History tells the story that is exactly the opposite to what I think is in the minds or the anxiety box of many regulators.
Yeah. Refilde, I'll come to you. Why might SARB persist with capital controls in the first place? What do you think is the...
I want to just, I want to start by sort of defending the regulators here. I think it's underestimated how digital friendly they actually are. It's underestimated how market friendly that they actually are. But they are sometimes bad actors or bad moments that they need to defend. And you need to decide if you want a 500 basis point interest rate hike because the rand was way too volatile. And their job is to protect the value of the rand, and they do that through interest rates. And there are a lot more people in the economy that are moving than just us in financial markets. And from that perspective, I think I can understand why their main issue is not actually the freedom of the market, it's just the sequencing. I cannot have, and I think the governor and the deputy governor have spoken about it's impossible for me to manage the price level or the price volatility within a country where I'm unable to monitor a large part of the market. And until those systems are in place for them to be able to actually monitor, to actually see the KYC and see how the movement of digital assets actually are affected on a day-to-day basis, both in private sector and in personal use as well as in industry, it's going to be very difficult for them to justify removing all the guardrails. The rand is not just, as maybe in the cases of the countries that some of the countries that Adrian mentioned, it's not just a function of payments and savings. It's a really large part of the global and global emerging market investment system. There are speculative bests happening all the time that may happen just seeking out a little bit of margin that could have a very massive impact on the South African economy, not just portfolios. And I think appreciating that, the Reserve Bank has to look after even the guy who's unbanked, of which there are, I want to say, only 43% of the South African adults are actually using their bank accounts on a regular basis, more than just to withdraw and actually use cash in a taxi or at a spaza shop. You understand what I mean?
Yes, yeah.
And that's the Reserve Bank's responsibility, not just us.
Yeah, no, absolutely, I agree.
I think I'd also like to add into this debate the following, is that, as Adrian said earlier, an asset is a scarce asset is only valuable if it's desirable. And so the proponents of crypto need to decide whether they regard the asset as valuable or desirable because it allows them to circumvent regulation and act outside the financial system, or because it makes financial transactions easier, faster, quicker, and more accessible. And I think that's also a decision that needs to be made.
Yeah. No, I think another angle could be SARBs. They want to maintain stable policy, so they don't want to make left field decisions that might spook the markets. Deputy Minister Robyn spoke earlier this morning also about putting experts, digital asset experts within National Treasury to advise Treasury on, and to be able to advise them on the policy direction, to improve the ability for Treasury to analyze and collect data, to be able to make more data-based decisions, and that starts in with Adrian's point around the potential ungrounded fears of capital flight if those restrictions are lifted. So really, I think there's a lot of tensions, and it's a healthy debate. I think one thing that's certain is that digital assets have definitely, been it has resulted in a change in mindset, I think, potentially at a treasury level, and so we will have to see how.
And if I could add, I mean, the Reserve Bank have published already that they are investigating really potentially issuing their own central bank's digital currency, excuse me. And so again, they're not anti-progress. It's just the ability to monitor is, as I think Pete mentioned, the regulators need to be able to catch up. And this is such a huge wall of money that could run away from us very, very quickly if the regulator hasn't got the framework in place.
Yeah, 100%. We have our stablecoin panel, I think, right after lunch, so we'll get into the details there as well. But I think one easy, not easy, but one, I think, obvious solution would be to enable stablecoins to be reported through the same balance of payment system that's currently used to report dollar inflows and outflows, and to also report international card transactions. So I think that would stimulate growth, especially as stablecoins being used as a settlement layer and not necessarily, Bitcoin or the other speculative assets. Let's move on to the African experiment, because...
Sorry,
yeah, sure.
This is your... the one thing to sort of tack on to Refua's observation is one facet that we can be, I think, hugely grateful for is that we have a progressive regulator. Is that this is not a regulator that's trying to tack us to the past or bind us into something that used to be. And that overwhelmingly our regulator is consults and is building frameworks for a future rather than a past.
Yeah. Absolutely.
So let's move on to the African experiment. At Luno, we've experienced this firsthand over the last 13 or 14 years. Africa isn't waiting for theory to resolve. It is, last year we had more than $200 billion worth of stablecoin flows moving through sub-Saharan Africa. Not by design, but because the formal system in many emerging markets couldn't support business. So this experiment is running in real time, and it's very, it's a privilege to live through this. There were other experiments like the Euro, which is also playing out still, and we'll see how that evolves. But the question is no longer whether institutions, participate, especially in emerging markets. Those adoption is already happening. So, Refulwe, in your view, when does a workaround, if you can call digital assets and the infrastructure right now, when does it become permanent? At what point?
I would say we're already there for the rest of the continent. Yeah. I think, the existence of a very deep and established South African financial system and powerful big 4 or 5, if you want to count Capitec as well, banks with, as Adrian says, very strong relationships with the regulator, probably doesn't allow the mushrooming that has happened as easily in the rest of the continent. And again, because they exist, that need versus greed is where we still are. It's more people looking for profit. It's people who are portfolio trading between gym sessions. Oh, my trainer gave me a hot tip. Yeah, my best friend comes to me and he tells me about what his trainer said, and I'm like, okay.
True story.
Yeah. And so the need part is not actually what's driving the South African part of the market. But on the rest of the continent, the need is so required. You've got such a large externalization, whether it's diaspora and remittances for family, lots of people who are sending money back home, the ability for people to trade in different currencies. It's not just about the dollarization of a local economy. It's about families actually being connected through those kinds of remittances to a far larger degree than what we see in the rest of in South Africa. And so, as I said earlier, Nigeria is kind of the biggest adopter. Kenya, Uganda follow South Africa, I think, is second to Nigeria. And I think the 4 outside of SA are the ones that are playing on the need scale. And so I think that adoption is going to continue to be extremely aggressive now.
Yeah. Staying on the need scale, Adrian, you do a lot of research, Africa research, thinking of your where to invest in Africa, the RMB report that you publish annually. The Africa Free Trade Agreement is, promised to unlock billions of dollars in intra-Africa trade. But do we have the financial infrastructure, pan-Africa, to support that flow of funds and the flow of capital? And do you see digital asset stablecoins as an example unlocking that and playing a role in the Africa Free Trade Agreement and how that develops?
Yeah, if we go back to the conversation with Refuwe, you've got some really perverse circumstances. If you're trying to get money into Malawi, good luck. There's a hefty cross-border transaction tax. If you're trying to get money out of Malawi, good luck. It's trapped. So the existing system simply doesn't function. It's very dysfunctional. Let's not say it doesn't function. There's all types of taxes, starting with your home currency fiat tax, then your transactions tax. I like that you referenced that it's going to unlock billions of dollars. Can we rather say it's going to unlock billions of stablecoin? That's the potential, and absolutely. I'd also come in right behind Refuwe on the point that we're already on that platform. That is the state of being. Nigeria is probably the best case in point, where the regulator tried to sort of clamp down and get their hands on everything, and the system just went dark. And then they said, okay, you can come back. And wow, you've got widespread adoption. So I don't think that this is something we have to speculate about. I think we're there already. And that's where it becomes then a circumstance of thinking about what are the institutional and infrastructural arrangements? Do I have rule of law? Can I enforce my contracts? And so those invisible things are what really creates the investability case rather than the ability to get money in and out.
Yeah. Deputy Minister Robyn also made a comment earlier where he said that innovation will always outpace policy and regulation, but innovation should not outpace accountability. And so I think that in the context of African markets, you mentioned Malawi, I think that's extremely important. I think regulation is going to be one of the catalysts in those markets. Yes, it is possible right now to access dollar stablecoin liquidity through a peer-to-peer or underground over-the-counter desk. It's possible, but for institutions, with clear governance frameworks to access that dollar stablecoin liquidity in order to make a cross-border payment to pay for imports or to repatriate profits to a headquarter company elsewhere, you need regulation in order to create the infrastructure on the ground. So I think that's,
Absolutely.
If I can add there, I don't have a high level of optimism about the regulatory environment in Africa providing the framework for massive cross-border transactions. I earlier made the comment that weak governments with weak financial positions tend to put barriers up, gates up, to push the capital into the killing pen of inflation, because that's how they survive. And that's exactly what Adrian referred to in Malawi. You can't get in, you can't get out. The money is trapped there, and it becomes worth less and less and less over time, because that's how that government survives. And the same has happened in Zimbabwe, the same has happened in many, many African countries. And it's not going to change because the governments themselves are weak and poorly financed. But I do think that stable coins and very liquid, large stablecoin systems can even provide the means for institutions to move money cross-border if they are so determined to do that. And I think it's quite possible.
I also find that for our big four, or big five, I think Absa has adopted a payment platform for Ghana, for example. So it can also be existing institutions evolving. It doesn't necessarily have to be something new cropping up. And I think that really that helps in terms of, I suppose, the trust that Pete feels he lacks at the moment. I want to be able to see Standard, Stanbic, whoever, somebody that I'm familiar with out there, and also being able to say that they are fit for purpose in this current climate.
Isn't that what Bitcoin is, a decentralized trust? And that replaces the lack of trust between governments and the local institutions in weakly governed countries.
But Refu, your point also about an established institution, a large established member of the Big Five, for instance. Very often when you've got new technologies, new systems, it takes a long time for this trust to build, and so the adoption has a huge lag in it. But if a big institution comes along and says, this is what we've got,
Right.
the central driver of any banking system is this invisible thing called trust.
Yeah.
And so if you arrive with that, you progress the chance of adoption.
I think so.
Before we go to questions, Pete, the African experiment is running. What do you think is the one thing that institutions should do? If you're an institution operating in an emerging market and you're not yet participating in some shape or form in the digital economy, what is the one thing that you would recommend them to?
Well, I think there are two things, if I can be so bold as to double the requirement. I think institutions aren't participating because of two reasons. The first reason is the regulatory framework is not yet conducive to participating. So if you're an institution, I think you should be pushing hard at the regulator, and that's how this thing works, to get the framework, the correct framework in place. And the second thing is you should be pushing hard at the intermediaries to get the cost of transacting down, because I think the cost of transacting in the system is still way too high.
Yeah. Okay, so let's go to the questions. I can see them coming through here, so thank you very much. The appetite for US dollar stablecoins is much more than the appetite for US dollar fiat currency. If an individual can pick a currency from a menu, it seems like they always pick US dollar. By removing the resistance of acquiring US dollar-based coins, does it pose any local economic risks? So I guess this speaks to the sovereignty of local currencies, local fiat currencies. Who's brave enough to take on this question?
Well, I'm happy to speak from the perspective of what the Reserve Bank has already said. You are undermining my sovereignty, and you would undermine my ability to effect monetary open market operations like interest rate increases and decreases, like bond purchases, if a significant portion of the money moving in the country or the US dollar-based coins is not actually regulated or at least monitored. You can't have not just a payment system, but a money system that cannot respond to Reserve Bank into it's not my first language. Reserve Bank interjection or playing into the market. It leaves them toothless. And then again, as I mentioned earlier, you're probably going to have to find yourself faced with far more aggressive interest rate hikes in order to get the transmission function to actually pass through.
Yeah.
There's a lovely, I'll corrupt his statement, but John Maynard Keynes says one of the surest ways to bankrupt a society is through inflation. And a way of creating inflation, Pete speaks about this, has spoken about this on a couple of occasions in our time together. Inflation is the result of printing money. And printing money has a flip side. It has a thing going on in the underbelly called seigniorage, which allows me to essentially harness or harvest value by issuing currency. And if you take away my ability to issue currency, then you remove my ability to accrue seigniorage. So there's a whole lot going on in the underbelly of this also that I think we need to give some weight to.
Fair enough.
Yeah. For me, okay.
Shall I ask it? Right. Marius,
Please ask.
what would you like to see in the next 5 to 10 years in terms of exchange controls? And what would be a win for Luno?
That's a discussion for
Am I allowed to say
for
this?
drinks.
That I was Marius's professor. There's our conflict of interest declared.
We've, as Luno, we've been approached by businesses, companies in South Africa with interest in other parts of the world, headquarter companies with subsidiaries in other African and other emerging markets, companies that export fresh produce from South Africa into Northern Africa and the Middle East. All of those companies manage and have to manage a great deal of risk in terms of currency volatility in emerging markets, the stress of being exposed to market risk because of a 1 to 2 and in some cases 6-month delay in receiving payment for their exports, for example. Companies that are unable to access dividends declared from local subsidiaries. Companies that cannot repatriate profits legitimately from other markets. So there are all these stresses that businesses experience, and it's a regular Monday morning challenge for them. It's not something abstract. And I think a win for us would be, if these businesses were all South African-based or headquartered or have roots in South Africa in one way or another, can use other means available, for example, stablecoins, in order to solve some of those real problems that they experience. In order for that to happen, the Reserve Bank and National Treasury must allow businesses, and not only individuals, to receive stablecoins or digital value from cross-border inward into SA, or to be able to transact outward in dollar stablecoins. Our fear is that that is not the case, and it's not going to be the case when more detail is shown. And that privilege will be reserved for individuals who want to invest more than the single discretionary allowances or the annual allowances. So we do think that there's a very big opportunity for us as a company, as a country, to stimulate growth, to contribute to the growth and in this country. And here we have a technology and in digital assets and the infrastructure that can really be one of the catalysts to drive that growth. So a win for us would be in the next 5 to 10 years. Obviously, we think that exchange controls was not designed for the current era, 2026, where digital assets really knows no borders. And so that in itself is going to create friction. But as discussed here, we have to understand the history of exchange control regulations and the Reserve Bank's current mandate and the process that needs to unfold before exchange controls can be lifted completely. So we think an environment that could stimulate growth, that could stimulate activity for local businesses, where digital assets can be reported, similar to how FX and other cross-border transactions can be reported, and creating that level playing field, we think that will be a win for SA. What, in your view, would South Africa look like without exchange control regulations? Adrian, you touched on this earlier. You took us through one or two case studies. Do you mind just recapping that? I think you said India.
Sure. So Maurice, I think 2 points. First, to pedal back to the earlier observation that Pete made, which was, for the most part, South Africans don't experience exchange controls. The recent lift was from 1 million to 2 million. And if you've got, 2 million spare knocking around each year, you're not in the 1%, you're in the 0.1%. And then you've got your 10 million allowance, etc. So overwhelmingly, for individual South Africans, there is no such thing as exchange control. There is ex-con for a very small set. And I suppose I just make that by way of observational backdrop. If we go to the economic history, and I'm a massive subscriber to evidence-based economics, as opposed to I believe and I think, or I imagine. And the evidence that we get from economic history is overwhelmingly in favor of the removal of exchange controls. That we could let's play the reverse game. Name the countries that have become prosperous and flourished under foreign exchange control.
China?
With one big wall. Eh? So the evidence leans overwhelmingly in favor of. And so I'm a subscriber based on that evidence, and I made reference to South Korea, India, Chile. And this isn't to suggest, a big bang approach and, just smash the piggy bank and everything's going to be fine. I think always and everywhere, and especially when it comes to financial systems, you want stability, you want transparency, you need trust and confidence in the system. But it's hard for me to arrive, based on that evidence, to arrive at a conclusion that says, and foreign exchange controls have been good and will continue to be good for South Africa. I can't complete that sentence.
Okay.
I would add to that, if one looks at surveys the financial landscape of the world right now, you will find that in most Western economies, governments are over-leveraged, over-indebted, and stretched.
Yeah.
And the natural response to that is to start putting in controls, as I said earlier, on capital flows, on people flows, and prescribed assets, all those sort of things. The sort of things we had in South Africa pre-1994.
Yeah.
And that, I think, unfortunately, will be the direction of travel going forward in Western markets. And I think South Africa, will be susceptible, the regulators here will be susceptible to that direction of travel, unfortunately. Because, I would also like to live in a world with no controls at all. But we've lived in a world over the past 40 years, all of us in this room have lived in a world where controls have been released gradually over time. And I think the next 40 years might just be different. So I think one needs it's worth keeping that in the background.
I would only add to this that, I think the economic background, the financial background is always very important, but at the end of the day, and at the core of regulation, is a very big political bias. And I think we can never forget that as much as the Treasury works with numbers, it also works with very vocal stakeholders who perceive those who have 1 to 2 million rand extra at the end of the year to put away in a particular way. I think it's not the kind of thing that happens in an election year, for example. I mean, I know it's only municipal elections, but I think that you get some very resistant voices. And even when they get it wrong. I mean, the fact that they were coming for inflation targeting at some point, even when they get it wrong, they are vocal and they can really rile up those. It's populist and at the end of the day, that 2 million rand was Adrian's in the first place. I'm not going to get it if he can't take it offshore. Do you know what I mean? So it's very theoretical and it's very populist. And I think that the tougher we get, or the more uncertain South Africa gets, the more difficult the liberalisation conversation becomes for even the most liberal-minded in the policy-making spaces.
Yeah, no, for sure. I think there's a few factors. There's the complexity of unwinding exchange control, which I think is also daunting to the Reserve Bank. There's the political agenda and that narrative. There could even be, competition or even pushback from the financial services sector.
Sure.
Also built their businesses around that and their business models. So there are a few factors at play.
Again, I think if you're scared of the South African exchange controls, you need to be very cautious about where you think you're going to move the money to.
Sure. Oh, that's for sure.
Things could change.
Hopefully to your hardware wallet.
Cold wallet.
Cold wallet. I think we have time for one more question. Pete, I think this is your name written all over it, but let's read. Low correlation to traditional markets has made crypto attractive, but correlation is increasing. Will this harm or aid crypto adoption?
Well, I'd like to question the statement there that says the correlation is increasing. I mean, crypto has been going down where stock markets are flying at the moment. So I think the correlation is still pretty much intact. It's might not be negative, but it's not becoming increasingly positively correlated. I think it still acts as a diversifying asset in a sensible portfolio. The question is, as Adrian pointed out, how much do you want to allocate to it? But I think it still plays a strong role in a diversified portfolio. Despite prices going down, other prices are going up. So if you had a diversified portfolio of equities and crypto right now, you'd still be looking good. It's fine. It's not a problem.
Yeah. And we have time for one more. Nice practical question. So I think I'll open this up to any of the three panelists. As you've added Bitcoin crypto to your portfolios, what vehicles have you used to do that? ETFs? Presume this was through offshore bracket brokers. So, yeah, what is your preferred?
I'm going to start there, and because I run what used to be called a unit trust collective investment scheme, we are not allowed to invest in Bitcoin. So I have no Bitcoin exposure in this fund because of the regulatory environment. Hopefully that will change. So I've used none of the above. Not for a lack of trying, though.
Short answer. So in the case of, and also sort of the observation around regulation, I think you suggested earlier was a fund that I run, as a portfolio that I run.
Okay.
Multi-asset portfolio, not a fund. And inside of their exposures through ETF.
Okay.
No, most of my boards at the moment are private equity, private debt. So.
Okay, right. Yeah, I think the panelists made, I think, clear that this experiment is running, this digital asset experiment. There's a change in mindset, I think, that is driving much of this, and that the question is now is how this is going to shape going forward. So thank you very much. Thank you, Adrian, Piet, Refilwe, for your time and for your comments. Appreciate that, and thank you to the audience for the questions. Thanks.
Thank you.
Right. Thank you very much to Marius and the panel. I think we all can agree that was a riveting conversation. I mean, just looking at the stature and the collective knowledge of the panelists, that was an absolute masterclass. I could have easily sat there for another hour listening to them. However, I can hear some tummies grumbling. So it's time for lunch. We're going to break for an hour. We'll be back here at 2:15. And then it's when it gets real interesting, when we move beyond the experiment into real-world utility, and we talk all about stablecoins. Enjoy your lunch, and see you later.